Why don't we start, if we can, with this? It'll help us, and it will. Can we go ahead, since we're waiting on one of our speakers, and put up our first panel, our first poll, excuse me. All right. We would like to know, in the jobs that you do, what is your greatest uncertainty or risk you face in your day-to-day activities? Now, granted, I don't know everybody's distribution of front, middle, back, C-suite, whatever, but we'd like to know a little bit about what it is your greatest uncertainty or risk, so we'll be able to kind of gauge that as it kind of comes up to us. But as we're going to start today, you can see our speakers here in just a moment. Daniel Barbosa, Haroldo, and Joanne. They're all extremely accomplished professionals in their fields of credit. To be able to address kind of a little bit today on credit and counterparty risk, about shifting the supply chain in new markets. You know, I think we've heard a lot today, at least on this stream, where you've had a lot of talk about geopolitical changes, tariffs. God knows what else has come across the news since I got off the news about 15 minutes ago. And it's very, very important that as we go through this, the panel, I think, has encouraged itself to really challenge it and give you some really good features of discussion. But as we're going to start out on the first question, it's going to be really more just rebalancing a little bit about where we're on the, how we rebalance and increase counterparty risk, tighter conditions in the wake of regulatory, geopolitical factors affecting credit risk assessment. So we're going to cover that today here on this panel. So with that, here's the greatest uncertainty that the panel can see. Certainly nothing that anybody wants to see that's in credit to say, gee, give me more money because I've got data and fraud and cyber in my company here. That's going to come back differently. But the first question I want to address to the panel, and I'm going to have ladies go first, is how is the uncertainty around today's global economic environment relative to the tariffs and the reciprocals impacted how you're navigating what you're doing every day in counterparty risk? I'll let you go first.
Thank you. So I think the word of the day is uncertainty. I think, as we have heard all day long, that things are changing almost on a quarter-hour basis. My breaking news feeds are really dictating what I'm looking at when I'm looking at global trade and especially, you know, in the international commodity space. I think the uncertainty is honestly the biggest challenge for me, and one of the things that's paramount in looking at this head on is communication within my organization. So if you're lucky enough like me to have a government relations department, you're in close contact with them, with your traders, with your execution teams, with your treasury teams. You're looking at everything, and you're keeping in very close contact with everyone and keeping communications wide open.
Okay. We'll go to the next.
Well, talking about the tariff impacts in trade flows, right? According to my experience, that we have business in the U.S., we import products to the U.S., we export products from the U.S., we have business, we have trade flows with Europe, China, and South America, Asia in general. Definitely those tariffs, but not only the tariffs, but the changes that follows the process, they impact deeply the trade flows. So some of them, they are just interrupted. Some business we used to have with China, we don't have anymore, so we have to find different outlets for the product. There is certainly a smaller appetite for certain commodities in China. The economy there is certainly weaker than used to be before, and that will have impacts. I'm curious about what will be the Chinese GDP for this year. I think that will be disappointed. And unfortunately, I think there will be impacts in this business. I'd like just to tell something that I saw yesterday. I was in Montreal, and I heard something from a businessman. He has this Canadian guy. He produces caskets, right? Steel caskets, okay. And he was telling me the difficulty that he has, because if he produced those caskets with Canadian steel to export to the US, he'll be paying huge tariffs because they're American tariffs. And the other way, if he buys steel from the US to produce the caskets there in Canada, he'll be paying tariffs the other way. So it's really have a deadlock. So so those tariffs bringing to us new challenges that we need to learn, and still learning how to deal with them.
Oh, yeah. I mean, agri-commodities based in Brazil. So in most aspects, we had a positive impact because, but in the inputs, we are a little bit, there are lots of question marks, but on the demand side, we had a positive impact.
So I think one thing is a takeaway you might want to know about your panel. They're all in similar roles, but different types of companies. So their vantage point may be from ADM different than it's going to be for a metals firm versus somebody who's on a softs firm that's in Brazil. You're going to have different challenges and different circumstances that are going to be reflective just because of the similar types of companies they are. So I thought I might mention that to you if some of you don't know their backgrounds or don't know their companies. But if you want to ask questions specifically, you're going to get 3 different types of outlooks from 3 different people with 3 different companies. Okay, I'm going to run the second poll right now. And do we have that up? Has risk mitigation or management become more difficult since Liberation Day? I don't know how long ago that was. Can anybody tell me when that was? Was that
April
like?
2nd.
Huh?
April 2nd.
April 2nd. So since April 2nd, has it become more difficult in risk mitigation for the tariff announcements? What has become more difficult, or has it become that more difficult? Just a simple yes or no. We'd like to know that. So in generally speaking, for the panel, what in kind of risk mitigants are you typically employing to manage what you have? And in such case, I refer to that as AR, mark-to-market, trade credit, insurance, collaterals, security, payment terms, any new things that you're having to explore. You've always had these tools in your toolkit, so to speak, but now that we've got Liberation Day, what are we using? What are we focusing more on? Have we changed anything, what we're doing? Is there anything new that gives us a little bit more of an extra edge in the market? And we'll just keep the same batting order here, if that's okay.
Sure, of course. So I think, as you said, the tools have always been in the toolkit, but it's like moving them around. It's constantly reviewing counterparty quality and country risk, and not only relative to all the changes with the tariffs, but also taking into consideration any kind of political or economic unrest in certain areas of the world. You're likely to want to be potentially changing payment terms, making things more secure, maybe in some cases less secure, usually not. but it's a balancing act because we still want to make sure that we do business, and so the risk mitigation aspect is very important, and we also want to make sure that the cost isn't too exorbitant for our commercial teams, because I mean, we're in this to make money after all, so we want to make sure that our risk mitigation strategies are smart and cost effective.
Hang on just a second. I want to go over these panel things. Who's the 25%? Anybody want to wear up to it? Because I think it's become harder. I think everybody would agree. No big deal.
I'm curious as well.
There's somebody with $1 million out in the audience that wants to hire you. No. The next thing, we'll go to Haroldo. Go ahead.
I love your answer. It's interesting. When I talk about risk, Joanne and the others, it's important. We have to balance risk and gain, right, and profit. So if I have a riskier environment, we have to aim for bigger margins, or unfortunately, it's not always possible. So every time we close a deal, a trade, one important point that Joanne brought for us is the payment terms and the credit terms. So in more volatile and riskier environment, we tend to demand more secure credit terms. But unfortunately, the market's volatile. There's a lot of pressure to reduce inventories. As the risk is higher, the interest rates worldwide are higher, so that increase the inventory costs. So you have a higher inventory cost. There's a lot of pressure to sell the product in the market that is demanding less. So we have a lot of moving parts that we have to combine at the same time to try to manage that risk in this very uncertain and volatile environment.
I think we kind of got used to a very predictable world since 1990. Yeah, but if we look in history, that's not the reality for the past 500 years or 200 years. The world is a very hectic place. We got lucky to have 30 years that were quite peaceful and low interest rates. And if you start, I started in the 90s. I started working in the early 90s. And I think the world is like a convergence to the mean. The mean is quite mean, actually. And so the world is a difficult place. And perhaps we'll have to look into in our toolbox and find the rusty tool your grandfather used. Yes. We'll have to resort to old strategies, old approaches. I was talking to my daughter, you have to study philosophy, you have to study history, you shouldn't study business only. You need a broad knowledge of the world, because the world is becoming a more difficult, less predictable place. And companies have to adapt to that.
Yeah, I think that was one of the things we discovered in our pre-call looking at this, is each one identified, as I mentioned, there's separate types of companies, but all identified that you're dealing each in physical commodities, and you have to go to your basics. I think that, Joanne, I wrote down your comment of balances to support the business. You have to support the business. You've got to make delivery of product. All the things that are associated with the variables within risk mitigation, to know about your counterparty. And like you said, you're moving different factors. You're like a juggler and you're having to juggle different things. You know, just looking at those as different things you're having to juggle, is there any one that comes to mind a little bit more than others? Because, I mean, I think we all would say that because of Liberation Day, we now have one more thing to concern ourselves with. I mean, I've heard this word tariff, I don't know how many times today, and I'm probably going to hear it more today and tomorrow. But now we've got something incremental to the basic fundamentals that we've all been trained to do in our work. Is there anything that stands out you're having to pay more attention to than the others?
Origin, actually,
Origin?
of the goods. Yeah, I mean, now U.S. origin goods present an additional risk for me that didn't exist, you know, prior to April 2nd, because there's another potential factor where your counterparty may default. And so that's, you know, one more thing to sort of factor in.
I'd like to, you mentioned origin, I'd like to mention destinations.
Destinations.
So we need to find alternative outlets or alternative markets.
Okay.
If you have you're having difficulties to find or to bring product to a place, if you can't sell product to China, it's mandatory. You have to find an outlet for the product. So I would mention origins and destination.
In the prep call we had, Haroldo mentioned something I found very interesting: low inventories. I think it's an increasing problem because of money is costing more, so people are cutting costs, sometimes not in a very intelligent way. So low inventories, I think, is a very risky thing. It adds, it brings volatility to a scenario that's not very bright at the moment. And I think we should pay attention to that. And I was thinking, because we had a very interesting talk in the prep call about it's a huge impact, because we saw what happened in the pandemic. Yeah, inventories were all right, but in a short time they were very low, and nobody was prepared for that.
Yeah.
And much of these policies.
Well, and I think I like the way you said it a minute ago, where you talked about how that you may have to go back into the toolkit and get an old tool again. I mean, I have to show my age a little bit. I'll just speak for myself. There's a lot of things, I think, in fundamental deliverable of commodities that are not picked up in some of the AI chat groups or whatever they're called. As much as I endorse them in the use of technology for building risk scenarios, you know, a ship on the water is still going to be a ship on the water that's unsold. You know, no algorithm is going to make it any better for you. It may give you scenarios, but it's not going to give you the buyer. It's not going to give you the seller. It's not going to get, you know what I'm saying? It's not going to change away from the fundamental basics that you just have to know. And I think that's where, you know, certainly the panel has identified very clearly, working as a team within the organization of your own people, your own skills, and everybody in different departments has to basically know each and every one of these things. You have one more thing?
Glenn, yes, Daniel mentioned something that I think it's important. I'd like to explore just a little bit more. When we're talking about inventories and risks, I think it's important to observe that a very efficient supply, extremely efficient supply chain, sometimes there has an aspect that increases the risk, because the whole supply chain tends to work with lower inventories and rely with the other parts that suppliers in different parts of the world, different countries. So sometimes a very efficient supply chain tends to increase the risk. And again, risk is probability and effect. So when you have a sudden, unexpected, abrupt disruption in the market with something like the event that you mentioned,
yes,
the tariffs. So that disruption impact a system that operates in a very fragile balance. So that's the problem. So we have an expected and abrupt disruption in a system that have been built for many, many years. The international trade system with the Incoterms, it's something that has been built not by us, but for many generations. We have the Incoterms. How many versions we have? We are Incoterms 2020. I will operate with Incoterms 2000. So that aspect, I think it's important. I'd like to emphasize the risk related with this, and because of that suddenly disruption, pressure on the inventories were even more complex.
Adding to that, I remember when I first heard of the Toyota approach of just-in-time lean producing, and it was groundbreaking to me. I mean, I heard people, the delivery gets the goods, the parts get delivered to the assembly line every single day. I mean, in terms of cost and money efficiency, it's brilliant. But in a world that is more exposed to uncertainty, it's like, do I buy a new car? Do I spend, or do I would much rather have my money in the bank?
Yeah.
You need a reserve. You need a reserve.
Absolutely. Absolutely. So moving ahead as we wind down here for today, which geographies are really presenting new or unexpected challenges to you? This for the panel, and how are you managing these? What's kind of, okay, so you have all these things happening. What's some of the new challenges and how you're going to deal with some of that?
Well, Middle East, Africa is always a challenge for multiple reasons, and over the past several days it got even more challenging. So it's just staying on top of everything that's happening and understanding the impact and knowing where your vessels are.
Yeah. Well, yeah, I mean, I think it's like you identified, it's your basic fundamentals. So as you said, you're handling your business cycle, your cash conversions, things that are priorities. Like we were talking about a moment ago in the middle office, cash is king. You got to watch where the cash is. Certainly if credit people don't know where the cash is, then you might as well just go get paper routes on the corner or something. I mean, I'm not sure you're going to be in business very long.
No, that's right. I mean, we're all tasked with protecting the assets of our companies, our respective companies that we work for, and part of that is minimizing cash conversion cycle, which is, certainly paramount for me in my role.
Yeah. Haroldo?
With the risk of being repetitive, I couldn't agree more. Cash flow. Cash flow. I never saw a company extremely difficult because the margins are low or they are not receiving the return of the investments, but companies with cash flow problems, that's fatal. So cash flow. At this moment, cash flow is critical.
And adding to that, I think leaner companies, I think we need to be, I was thinking about how do we handle that. And I remember in the 90s, there were two management fads. One was re-engineering, process re-engineering, and the other one was downsizing. I don't think we should go as extreme as that, but we should be thinking and rethinking our business, which trading desks are really profitable, which aren't. We should try and make a serious effort to be more efficient. And we should train our team members, our staff, to understand more about the business as a whole. Be specialized, but also good generalistic view of the business, of the overall running of the business. I think too much specialism is not so very good thing.
Sure. I think your point is well taken also in the fact that, when you look at a trading book that's not making any money, I mean, and you're financing it in credit with something that's, we're not getting a benefit. We need to think very carefully whether or not we communicate upwards that we're in the right businesses or not, because cash will become king, and you can no longer afford to have a non-investment grade or any circumstance that's going to put you at high risk, because it just takes one strike of the match these days for the fire to get started. I think everybody that's been in this business that I know would agree with that. Anything I'd like to add? Anything else you want to add on the panel? Anything? Questions? Anybody have a question for me? Somebody's got one. Yes, sir. He'll be right with you with the mic.
First of all, thank you. I have a question. In this new paradigm, what do you do when you have a counterparty where they have to start taking risk off? And, Haroldo, you're right. What happens when their products are on the water and you don't have a buyer? What regimes are you putting in place to deal with that kind of circumstance? Because it's almost like a force majeure in a sense. Just curious how you're doing that. And the second part to the question is, how confident are you in the risk numbers that you're getting? The models that you're using for potential future exposure, the models that you're using to score counterparties' credit, their new exposures that those counterparties have in their capital structure because of changes in the way their secondary and tertiary relationships are affecting them. How are you looking at all of that data and those? Do you trust it?
First, we pray.
Yeah. Yes.
Traders are increasingly becoming very religious.
In God we trust. So, I'm joking. That's a very interesting question. There's always market for the product. So we need to find, so if the right price, you find an outlet for the product. The problem is, if that price is according to the amount of the money you expect and that we pay for the product. So, and sometimes we have to observe the losses, that sometimes it's better to sell a cargo with small profit, with no profit at all, with some small losses than to lose the business. So that's the point. There are some markets, as example, in the past, we used to sell products to China. China now is not a viable market. India is buying, but India is paying much less than China. So we have to find a way. So that's part of the business to, fortunately, the thing that I mentioned about the stress vessel, there are trading companies offering me the product. And sometimes, on the other hand, that may be an opportunity or not. I sold a cargo, recently sold a cargo to Singapore. The buyer, after I sold the cargo, the market dropped, and my customer there, he lost $600,000 in the car, in days. I'm so sorry for that, but it's the market. So if you're in trading, you know that risk is part of the business. So the best way that I can answer your question is, you need, as much as you know the market, you have to find the place, you have to move and put your hands out, keep walking, and make things happen.
Do y'all have a response to the question?
Yes, and I think, part of it is upfront, which is assessing your counterparty quality. So, maybe you feel like you have to pray less if you've already done the upfront due diligence to your portfolio and sort of culled out some of the crappier risk, and you have better, credit quality in your portfolio. So there's less praying there. That's sort of the point. It's sort of like a preventative measure to make sure that your portfolio is, I mean, it's not always going to be 100% that way just because, as you said, the market and opportunities and things like that, and that's where you have to apply your risk mitigations. But in general, I think the key is making sure that your credit quality is as high as you could possibly have it, and so that when these things happen, you have a little bit more comfort because your risk isn't with fly-by-nights.
I'm sorry, do you see now the difference between traders and finance guys?
Did you want to respond, Daniel?
I agree with Joanne. I mean, if the position is too big and the situation changed dramatically, there was probably, unless it's fraud, yeah, which is a whole different story.
That's different.
Yeah. I agree with her. We should review the credits position more often, I think, especially financial leverage of the clients, the buyers. This, I think, if
I'm joking.
Yeah.
For sure we have.
But you mentioned also in your question, I want to make sure I clarify that I heard that right, is that you're saying they need to take risk off. Do you mean the hedge it off, take some of the length off in the book? Or what are you referring to?
Two parts to that. If you find a customer is adversely affected and their credit quality deteriorates and you look at their potential future exposure and you want to de-risk them, how are you approaching clients that have less means to de-risk their portfolio?
Right.
That's one. And the second is, at risk mitigation, I'm sure co-fast insurance is more expensive now. So how are you deploying those things and still being profitable?
Well, I would say this, it depends on the temperature of the situation. That's kind of let's say we're looking at one week risk. It's going to be a lot different than 1 month risk, perhaps, as to the velocity and the action that can be taken accordingly by authority levels of said panel members versus having to go to their board or their risk committee to say, we're going to ask a credit counterparty that's investment grade for more cash because we don't want to take your hit for us, okay? That's obviously a very difficult thing to do, but you know, this isn't Sunday school, okay? He talked about church, but this is business. And you know, just like the lawyers will tell you, you don't represent them, you represent your company. And so the other thing, the reason I asked the question I did in follow-up of taking risk off, I think that you have to be guarded that cannot be construed as taking risk off as putting on more risk. Someone who's fully hedged, and we all know those terms, convergence, and I'm going to throw market risk out here for just a moment, but using the term of convergence, you know, your physical component is somewhat related to a spot contract or index that's volatile. We all know that. And if you start having a trader taking off a risk that's something that's already been deemed convergent, you could be potentially adding risk because you don't know the illiquid portion of your physical commodity, and that's their job. So I don't know, I can only speak for myself. When I've been in situations where I've had to deal with an illiquid situation, you know, kind of in a capacity as a credit person, a risk person, anybody in the risk side, you need to keep sending the flare up till somebody does something about it. And keep it there because it's not something that's going to go away on its own. Once you're in a physical commodity business and you own a commodity that nobody wants, you just got to find somebody that will take it off your hands or find a way to mitigate it in some other capacity. And anybody that's a trader or been that knows that's how it works, right?
And as far as counterparty risk and sort of de-risking contracts that you're already in, we have actually had some pretty good success with getting collateral from some counterparties, bank guarantees and other collateral. So I mean, it sounds impossible, but it does happen and you can get it.
Yeah. And take action fast, yeah?
Yeah.
Because sometimes a lot of people see problems, but it will change, or give them a call. send somebody in 2 weeks to visit them. I think we should be very practical about it.
And pray.
That's the nature of the business. Anybody else have anything? Any other questions? Okay, I'd like to thank our panel for today. Thank you very much.